Well, what a start to 2025. There are so many moving pieces to not just US policy, but how it's also impacting international policy and response to the daily machinations of the White House. And with that, it's welcome back to the series, Eric Norland. Eric is the group economist with CME Group over in Europe, over in London. Eric, how are you?
I'm doing well. How are you?
Trying to keep up with the news and the market.
Yes, challenge, isn't it?
It's a busy time. And I guess we should just let the audience know that our roles are reversed. I'm an Englishman in New York and you're an American over in London. So you're very well positioned to gauge the European response to tariff proposals as well as the delicate Ukraine-Russian conflict. How is the Trump administration being received in Europe, do you think?
So they've hit basically all imports of steel and aluminum into the United States with tariffs. And so that will have some impact here in Europe. I think the Europeans are still calibrating their response to that. We've seen a Canadian response earlier today. Canada hit the US with about 21, I should say, tariffs on $21 billion worth of goods. That's US dollars, 30 billion Canadian dollars worth of goods. And so that's a tiny portion of the trade that Canada does with the US. Canada imports, I can't remember, something like 350 or $400 billion worth of goods. So this probably concerns maybe about 5 or 6% of what Canada imports from the US. Europe might respond with something like that. It'll be something calibrated. It won't be an overwhelming forced response. I don't think that there's a desire probably in Europe to up the ante and to see the trade war deepen as we go into April.
I think last week I saw on Bloomberg television, it was Mohammed El Arian who pointed out that every single one of the so-called Trump trades that investors had assumed would work out when his policies galvanized has been turned on its head. How surprised are you? Let's start with the dollar. How surprised are you that the dollar has weakened significantly during the first quarter?
You have to remember the dollar had a huge rally going into fourth quarter, starting around September 30th, when the odds started shifting in Trump's favor to win the election.
Right.
The dollar had a big rally. It rose about 9% on the Bloomberg Dollar Index. It's now lost about half of those gains. So it's still 4.5% higher than it was in September. What I think is interesting about this over a sort of trader's perspective is that the dollar's been weakening at the same time as the equity market is falling. And
Mm,
that's an unusual relationship.
mm.
Sometimes it goes in the opposite direction.
So very recently, the ECB cut rates. Let's talk about that a little bit. Unusual for the euro currency to rally as yields are declining, right? And the euro's been pretty weak on with a backdrop of insipid growth in the eurozone. How does the rate cut last week address the economy, and where does it leave the path for rates from here? Do you think?
The ECB has been very aggressive about cutting rates. They've cut rates much more deeply than the Fed has. I
Mm,
would think that's in part because up until now, the European economy was so much weaker than the US economy. The US economy had a really strong 2023 and 2024. The Europe really just didn't have. So they felt like they had to get rates back down, even though the core inflation rate in the Euro area, just like in the US, is still running above target.
mm.
So I think the thing for Europe now is that this is inverting now. So we've seen a potentially massive fiscal easing in Germany, where they're getting ready to potentially blow out the budget deficit to support infrastructure and military spending that could give a lot of fiscal boost to Europe. At the same time as the U.S. Is doing something that looks like a fiscal austerity. The Trump administration came into a large budget deficit of 7.3% of GDP. Now they're putting on tariffs, which is a form of taxation, and they're also slashing government spending. So that could potentially slow the US as Europe begins to accelerate.
Let's talk about that a little bit further in depth. The flip side of this is the recent surge in German bond yields, the yield on German government debt. This is wrapped up again in the way America's dealing with its status as an international peacekeeper. What are the takeaways on European fiscal policy and defense spending and the outlook for yields?
The United States has complained for many decades that Europe didn't spend enough money on defense and that many countries were at around 2% or even below 2% of GDP. And so now that the US appears to be changing its foreign policy quite dramatically, there's a lot of pressure here in Europe to boost defense spending. Germany is also underinvested in their infrastructure, and they've had 2 years of negative GDP growth. So before the current Bundestag goes out and the new one comes in, they're taking advantage of the sort of centrist majority to loosen up the fiscal rules to boost both kinds of spending. And Germany is unique among the European countries in that they can do this. So they can do it for two reasons. First, their budget is roughly balanced. So they're not really running much of a budget deficit. Secondly, their debt to GDP ratio is very low. For the government, it's around 60% or 59% of GDP. You contrast that to countries like France and Italy. France and Italy are running 6, 7% of GDP budget deficits, and their government debt to GDP ratios are well north of 100%.
Mm.
Germany is in this unique position where they really can do a massive fiscal expansion that will spill across its borders because Germany trades with the rest of Europe, but it will help to rebalance the entire European economy. So I think this is bullish, not just for Germany, but for Europe more generally.
President Trump recently refused to rule out a US recession,
Um,
and US stock markets are faring worse than other global bourses. Is US exceptionalism dead, do you think?
It's a difficult question, but I don't really believe that any country is ever truly exceptional in the sense that all economies ultimately behave by the same set of rules. And the US is doing better again because it was running these enormous fiscal deficits, especially after giving so much more COVID aid under both the previous Trump administration and the Biden administration, other countries, the Inflation Reduction Act, the Chips and Science Act, running this huge budget deficit that really boosted the growth rate. Now that's going in reverse. The US is now looking at lower rates of government spending, potentially higher taxes through tariffs. So there could be other tax cuts that come along in the future. We're not sure about that yet. But the Treasury Secretary, Scott Bessent, for a long time, he was a very successful trader with George Soros and then later on for his own firm. And I think he was a strong believer in the idea of what they call reflexivity, the idea that narratives dominate markets. People come to believe optimistic things like stock prices going higher, then people consume more and invest more, so stock prices go still higher. And I think that the rhetoric in the last few days about how the US might be facing a recession is threatening to potentially take that virtuous spiral and send it a little bit in reverse, which I think is why we've seen some statements from the Treasury Secretary, the Commerce Secretary, and the President in recent days and hours saying, no, in fact, we're not going to have a recession. They're trying to reinstill that confidence.
Now, I'll ask questions about international relations here. Canada, in particular, has taken exception to Trump's actions. How do you expect other leaders around the world will respond? Trudeau and Carney, or more accommodative like Britain's Keir Starmer?
Keir Starmer is in a unique position in the sense that he hasn't been hit with any tariffs yet. So we don't know how he would respond if he were. So far, what we've heard from the White House is there might be tariffs on the European Union as of early April. But Britain, of course, is not part of the European Union. The only countries where we have a really clear example of what they're going to do is China, which has responded by putting 10 to 15% taxes on various US agricultural goods that enter their country, as well as I hear some more targeted tariffs. Canada, again, responding with tariffs on $21 billion worth of goods in response to the steel and aluminum tariffs US has imposed. I think that I would expect that, Europe would probably respond proportionately to the tariffs. So if they get hit only with aluminum and steel tariffs, their response will probably be relatively small because they don't really want to encourage like a vicious cycle of like higher tariffs on both sides of the Atlantic. But if they do get hit with much broader tariffs, then their response might be much more severe.
Are you optimistic about 2025, Eric, or not?
I haven't been optimistic about 2025 for a while, in part because I'm an economist. They call it the dismal science for a reason. My reasoning up until now has been that the Federal Reserve and many other central banks around the world did these huge rate hikes over the course of 2022 and 2023. And monetary policy tightening often hits with long and variable lags. And so my fear has been that despite the fact that central banks are now easing, that some of the higher interest rates were going to come home and roost this year anyway. But when you add to that uncertainty over rapidly changing government policies, that has the potential to depress consumption, investment, as well as government spending. So it really hits three of the four components of GDP. So that's, I think, adding to my concerns and apparently the market's concerns. As I look at my screen after several down days in the S&P at this moment, as recording, is down for the third time this week, which is pretty amazing. There's no bounce yet.
Hmm. And that's despite good inflation numbers on the day that we're recording, which is March the 12th, Wednesday. Eric, thank you very much for joining me from London, and we look forward to having you on the program again.
Thank you again. Anytime.
And to the listeners, don't forget, if you like today's episode, please do subscribe from wherever you download your podcasts from. Bye for now.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.